The VOO ETF, or Vanguard S&P 500 ETF, is one of the most popular ETFs on the market. It's designed to track the performance of the S&P 500 index, which includes 500 of the largest publicly traded companies in the U.S. This makes VOO a great way to invest in the overall U.S. stock market with a single purchase. When you buy shares of VOO, you're essentially investing in a small piece of 500 companies like Apple, Microsoft, Amazon, and Tesla. These companies are spread across various sectors, including technology, healthcare, consumer goods, and financials. The S&P 500 is often considered a benchmark for the U.S. economy, so VOO gives you exposure to some of the most successful and stable companies out there. One of the biggest advantages of VOO is its low expense ratio. At just 0.03%, it's one of the cheapest ETFs to own. For every $10,000 you invest, you're paying only $3 a year in fees, which means more of your money stays invested and working for you over time. VOO is a passively managed ETF, meaning it simply follows the S&P 500 and doesn't try to beat the market. This passive approach typically leads to lower costs and more consistent performance over the long term compared to actively managed funds. Historically, the S&P 500 has returned about 8 to 10% annually on average, though it can vary from year to year. Let's break it down with an example. Suppose you invest $1,000 in VOO, and the S&P 500 rises by 10% over the next year. Your $1,000 would grow to $1,100, minus a small amount for the expense ratio. If the market drops by 5%, your investment would fall to $950. VOO's performance mirrors the ups and downs of the S&P 500, so it's important to have a long-term mindset when investing in it. Another key benefit of VOO is diversification. Because it holds 500 companies across multiple sectors, it spreads your risk. If one company or sector performs poorly, it's balanced out by others that may be doing well. For example, if the tech sector is struggling but healthcare is thriving, your overall investment in VOO won't take as big of a hit as if you were only invested in tech stocks. VOO is ideal for long-term investors who want steady growth and aren't looking to actively trade. It's often recommended for retirement accounts like IRAs or 401k. Because of its low fees and broad market exposure. By regularly investing in VOO, you can take advantage of dollar-cost averaging, which means you're buying shares at both high and low prices over time, helping to smooth out the impact of market volatility. However, like any investment, VOO isn't risk-free. Since it's tied to the S&P 500, its value can drop during market downturns or recessions. It's also heavily weighted toward large-cap companies, so it may not capture the growth potential of smaller or international stocks. To balance this, some investors pair VOO with ETFs that focus on small-cap or global markets. In summary, the VOO ETF is a low-cost, diversified way to invest in the U.S. stock market's top 500 companies. It's best suited for long-term investors who want to build wealth steadily over time. With its low fees, simplicity, and consistent performance, VOO is a favorite among both beginner and experienced investors looking to grow their portfolios in 2024.